Hi everyone, thank you for joining us again. Today we've got a very interesting webinar, talking about regression and frequency distribution and all this fun stuff. So I don't know if, like me, you've had an absolute distaste to all things statistical. Funny enough, in my engineering degree there was one subject that I failed, and that was statistics, and the faculty basically said, you've done well everywhere else, we're going to let you have that one. So I got a faculty pass for it. So it's quite ironic that I'd be sitting here teaching statistical concepts all these years later. I think my professors would roll over in their graves if they realised. Where all of this has come from is, as some of you would know, I'm running two 13-week courses for people who are doing CMT training at the moment, doing levels 1 and 2. Which has been fantastic for me as well. You know, there's a lot of things that, even though I've done the CMT exams, nothing like teaching something to really cement things home and give me a lot of clarity about the direction that we need to take Optuma as well. Two of those outworkings, if you're interested actually in the CMT education, you can check that out at learn.optuma.com. You may not even want to get the CMT designation, but you just want a more formal study in technical analysis. And so if that's the case, go check them out, because there's a lot of work that's gone into those courses, and there's a lot of material there. Learn.optuma.com is the place to go. Now, regression. What I'm going to actually do with this first part, because regression is one of those areas that scares a lot of people. Not many people really understand what's going on. So I want to go through the slides actually that I used for the CMT. There's only about 10 slides here, but we'll run through them. Let me explain why regression is important and how we can use it, and then we'll jump over to Optuma and do a few examples and show you how we can put all of that together. So regression 101, quickly, many inputs will drive a security's price. We've got sentiment. What do people think? What's the, what are the cycles? Where are we? Are we in a bull market? Is the cab driver giving us stock tips? Those sorts of things. Interest rates, benchmarks, other asset classes. What are they doing? They all drive what is going to happen, what the returns are going to be that we can expect out of any single security. Which input matters most? All of those. What can we ignore? That's where, regression 101. So in regression, what we have is our independent variable. Let's just take the case of Apple. Let's say that I want to know, I want to look at the weekly returns in Apple, and I want to know what drives Apple. Is there anything out there that I can use in the universe of other securities and other inputs that's going to help me identify when I can expect a good return in Apple? And so when we talk about regression, we talk about dependent variables and independent variables. The dependent variable is sorry, I'm just checking my notes to make sure I say this correctly, because sometimes I can get confused with some of this as well. The dependent variable is the one that we want to test. So that's Apple's returns, and it's dependent upon other things. And so it's dependent upon the independent variables. And they're the things that we want to test against Apple to see if there's a relationship there. So that's what we're doing with regression analysis. So, quick example here, we plot the changes in price along our x-axis for the SPX and for the S&P 500, because we want to test, in this case, how does SP 500 relate to Apple there. And so we put this chart up. We then get all these points. Now, each one of these points is for a week in time. What was the return in the S&P, being our independent variable, versus what was the return in Apple, being our dependent variable? And then we put a point on the chart. And we do that for every week of the year. So because this is about a year of data and we've got it on weekly, we would expect 52 points to be on that chart. Then we use the linear regression function, which finds the line of best fit, looks at all those dots on the y-axis, and says, what is the equation of the line that's going to have the variance around the line as small as possible? And that's what we come up with. Now, out of that we get two numbers. One is the alpha and the beta. So, going back to high school geometry and the equation of a line, where you've got y equals mx plus b, or in our case we've got y equals beta x plus alpha. And you'll often hear in finance people talk about alpha being outperformance. Well, alpha is actually the y-intercept on a linear regression chart. And then they talk about beta, which is the relationship between returns. It's the relationship between, in this case, the returns in the S&P versus the returns in Apple. And so beta describes that relationship, and it's the slope of the line or the gradient. And it's as simple as that. Now, just for full disclosure here, when people often talk about beta, they also add in removing the returns from risk-free. So if I was investing in treasury bills in the United States, for instance, or some sort of bonds or something like that, they would be risk-free investments. I'm obviously within reason. The bank, yes, the government can go bankrupt and things like that, and we can have debt ceiling issues, but for the most part, debt risk-free. The governments can print money to meet their obligations or raise taxes. So when we talk about beta in the official sense, and when people talk about it, they're subtracting away the risk-free amount. So we may have a beta of 1 and 1.2 on the regression chart, but then the official beta may be 0.9 because they've taken 0.3 off, which is the risk-free rate on the 90-day bills or something like that. So just a couple of things to remember with all of that. The lines here, sometimes we call it the least squares line as well. And obviously values of alpha and beta, they minimize the sums of the squared error. Lots of theory there, isn't this fun? Keep going. Line of best fit, the line's an estimation. We need to look at the variance from the line. The closer the data points are to that line, the more highly correlated we say these two securities are. So if everything was right on that line and it was an exact fit, then what that tells me is that if I get a 1% return in the S&P, I can expect maybe a 1.2 or 1.4% return in Apple. And they're highly correlated. And that means that when we talk about dependent variables and independent variables, well, this dependent variable is very much dependent on what's happening over here in this independent variable. And so how well that fits, it's donated by R, and which is called the Pearson correlation coefficient, bit of a tongue twister. And we can use beta to work out R as well. And so there's just a couple of formulas there, just for fun, because I'm sure you're very interested in this. Remember, with standard deviation and variance, we talk about the variance, when we talk about a moving average, and we talk about the variance of closing prices around that average, and we do a standard deviation calculation. Standard deviation is simply the square root of the variance, and the variance calculation, we take those gaps and we square them all so that whether it's above or beneath, we're getting rid of the sign of the difference and bringing it all back into a single number. R squared is something you'll hear talked about in statistics. All that is a measure of the variance, and particularly in this type of linear regression, when we're looking at these spread of dots around the linear regression line, R squared is just a measure of variance. The smaller that R squared is, the more highly correlated those two securities are. So that's enough. Coefficient determination, we don't need to know about that. Multiple regression, we're not going to get into that today, but just know that that can be done. We can do multiple independent variables and test against our dependent variable as well. But we haven't built that into Optuma yet. And then multi-collinearity, just for fun, and then assumptions, and that's it. So what we're going to do is just switch out to Optuma, and then we can have a look at exactly how this all plays out in practice. So in Optuma here, Let's just go in and under new. Now, I'm not sure exactly whether everybody's got this yet. Our regression and frequency distribution, definitely in the professional services editions and in the lifetime trader services editions. You'll definitely have these two there. So obviously a big plus for our lifetime clients. And so let's jump in and go to regression chart, and let's do Apple, since that's what we were talking about before. So a different time frame here that we're looking at. We've got our points added here. Again, we've got, you can see down in the x-axis, it's our changes in the S&P 500. In the y-axis, it's the changes in Apple. And we can look at any one of these points here and see what they are. So we've got a 1.28% return on SPX, and then Apple at 96.68. That's the price, sorry. I'm reading that thinking, hang on, 96%. Its return was at 0.82% return. And you see the two prices there, and also the distance to the line as well from a y-axis. And so we've got the line of best fit, and if we hover over the line, we can see, I'm not sure whether that's going to be clear, but I can see my R squared is at 0.207. So these are fairly highly correlated. Correlation goes from a value of 0 out to 1, alpha at 0.24, and that's our y-intercept. If I zoom right in on the y-intercept there, 0.241 is what our y-intercept is, and beta being the slope of the line, 1.1917. So we've got a beta of almost 1.2 I should say, which means that for every 1% return in the S&P, what this is showing us over the last year is that we've had a 1.2% return in Apple. So Apple's definitely been outperforming, and that looks really promising. So we've got the regression chart there. Just a couple of things are obviously worth showing. I'm looking here just at the last year, but of course I can go back to everything, and I can go through time as with everything and look at how the regressions played out at different points in the market. There's where did I see it? There was a point here around in the 90s where there was obviously a negative correlation. Now, very loose negative correlation. The spread of those dots is very wide, but the beta is negative here. And so we've got negative 0.48 beta. So for every % gain in the S&P, there was a 0.5% loss in Apple. R squared now sitting at 0.0256. It's getting out, way too big. It's getting, the spread there is too wide in those numbers as well. So this is the regression chart. The way we've set this up is that you can do anything, whether you want to do two securities like I've done there, or maybe you want to do Apple against one of the fundamental numbers of Apple, or maybe a fundamental number of S&P. If we just come and have a look at the properties here, you can see that we've got our dependent script. Now at the moment, by default, it's just the change, but I could make this anything. I could make it RSI values, and I could be investigating, well, for a change in RSI, how does that relate to the change in returns? And there's a lot of flexibility in the type of analysis you can do. Independent code, again, I could come along here and say, well, let's just make the independent code Apple. And of course, as you would expect, perfect correlation in that situation, because I'm comparing the change in Apple to the change in Apple. So yeah, they're obviously perfectly correlated. But maybe I want to do this one here and say, right, let's just make the independent a RSI and hit apply to that. And what do we have? We've got probably spread. Okay, so we've got our values sitting over here, and we can look at that and do our statistical analysis. This is a study in relationships to talk about if I've got an idea, if there's something that I want to invest in, and I want to look at, well, what is its relationship to another security? So for instance, one of the most common ones that we've seen is that the Australian dollar, because Australia is such a resource-rich nation, the Australian dollar is highly correlated to the commodities and the commodities index and the price of commodities in general. And so doing this type of relationship, you know, gives us some ideas of, well, where do we think that the Aussie dollar is going to track? And, you know, so really from 2016 onwards, commodities have been slowly inching their way higher, and the Aussie dollar has been doing the same thing. And so, you know, regression chart lets us look at those relationships. The only deviation to that relationship actually, I believe, was due to quantitative easing. Because commodities are in US dollar, quantitative easing from 2010 through to 2013 devalued the US dollar, and you see a bit of a spike there in commodities because of that. But I digress. That's the regression chart. Just again, as an example, let's just go to an Apple bar chart. Oh, wrong security. Let me just type in AAPL. There we go. And I want to change that to weekly, and I want to add the Pearson's correlation coefficient. I just use Pearson's because it's a little bit easier. We obviously have the correlation tool where you've got two securities on the chart and you can take the correlation between them. Pearson's is just easier because it goes to the index. And I can change that index, and so it's easy to add on. Remember we had that period in 1996 where there was a big downward slope on the regression. Well, the correlation is showing us that information as well. And we can see the relationship between those two securities. The thing that this doesn't give us is that alpha, the beta, and a much better understanding of, well, how closely correlated are these and what is the spread as well. So there's a bit of advantage there. So that's the regression chart. You know, lots of fun. Exploring and trying to get in there and understand that. Now, another chart which we've created in 64-bit version of Optuma is the frequency distribution chart. Now, from our signal testing work, you remember the frequency distribution or the profit distribution charts that we have for the returns out of the signal test, and also for the Monte Carlo of the returns. Both create these frequency distributions. And all that is saying, let's take all of the returns that we get, let's put them in bins and then count how many times we get that. So for instance, if I had 1% bins, so I went from 0 to 1% return to 2% return to 3% return, and I got a return of 1.5%, well, it's going to go in the bin from 1 to 2%, and it would count as a return in there. And then we count how many times we get that return, and that gives us the curve. So let's go and add one of those. Go to a new page here. We'll go to new, and we will do our frequency distribution chart again on Apple. I've got daily returns here. Let me go to weekly. So we've got our weekly returns here. Now this is set to 20 bins, so it's a bit big. Let me come along here and make that 50 bins. I think that'll be a little bit better. Okay, so we've got 50 bins here. I can see in the middle, we may have to put a dark line in just to mark this, but you can see in the middle where we've got 0%. This is our break-even point. So it's really sort of saying, if I look at the weekly returns of Apple, so based from one week to the next, how much did it make or lose? For the last year, what were those returns? What was the distribution of those returns? And so I can look at this, and what's telling to me immediately is that my highest point, or my mode on this chart, remember mean being the actual average of everything, of all the returns that we get, the median being right in the middle. If we lined all of our returns up in ranked order, the median would be the value in the middle. The mode is the value that has the highest frequency, and so that is the highest point in this chart. And I can see that that is on the positive side. I've got to make sure I do this right for you. And so that's great. You know, I can look at that and say, hey, this is really nice. I'm seeing that this chart is skewed off to being positive returns. I can see that the average there, the mean return is 0.29, the median is 0.58. The mode is obviously sitting out in 0.5 to 1. So this is all really good for investing here. The reality is with technical analysis, we can use our indicators and we can have an idea of, well, where are we going to get our returns from? But also if we're holding securities and we decide that yes, technical analysis has helped us decide that we want to have Apple as part of our portfolio, how long we hold it for, we may need to be looking at this to say, okay, well, what are the returns that I can expect over my typical hold period? And that's where these charts are really helping in creating that. Again, we can do this with scripting. I can come along with a script and change that and say, well, I don't want to just do the change over a week. I want to look at some complex things, and I want to look at the distribution of anything. So it could be the distribution of RSI values or the distribution of Gann swing charts. You know, those type of things, we should be able to write scripts and be able to create these distribution charts. Again, my goal here is really to make you aware of the type of analysis that you can do and how you can work with these. Now, up the top of the frequency distribution chart, we've got obviously the title. We have the mean as the average, the median, standard deviation. So remember with a Gaussian curve, when we talk about Gaussian curves, and you'll heard me mention this a lot about how the average can be a deceptive number. And I often quoted the example of 0 versus 0, 50 and 100. Well, the average is 50, 49, 50, 51, the average is 50, but those two sets of numbers are very different. Well, the way we deal with that in statistics is to use what we call the 4 moments, which describe our distribution and our average. Now, the first moment is the mean, that's the average. The second moment is the standard deviation. What's that spread around the mean? And we want to have something which is fairly high and tight. It means that we have a lot of certainty. What we want as traders and analysts is that there's an element of certainty around when we go to market that we are going to get that result back out, particularly if you're testing strategies and ideas. The higher and tighter, the better as far as we're concerned. The other 2 moments that describe Gaussian curves are skewness. Now remember, I already talked about the mode being skewed positively or skewed in profit. That's actually a negative skew number, but that's good for our point. You can see that in the top there, we have a negative 0.18 skew, which just means that the mode is moved away from the mean. But negative is good, positive is bad. And then the last one is kurtosis, which just describes the shape of the curve. And it's a relationship between the height and the width of it. And 3 is the perfect normal Gaussian curve. So we have a kurtosis here of 3.95, nearly 4. That's good. Anything higher than 3 gives us that high and tight. So getting around 4 is actually a really nice number there. When you get above 7 or 8, then it starts to get a little bit iffy about some of the results. Mind you, in signal testing, we often do see high numbers because of the massive spread as well. So that's the frequency distribution chart. One thing I should add as well is, depending on what you're using, you may want to use log normal, which takes the logarithmic of values. Sometimes you can get skewed distributions, but once you take the logarithms of them, they make more sense. So you have that option there, and you also have the option to remove outliers as well. It doesn't change the 4 moments, but does change the way that the bins may be calculated there as well. And you can choose to round the bins or not, is the other thing as well there. So a quick little dive into some very fun statistics in Optuma. There's still a lot more that I want to be building in this area, and different ways of creating that. This is, in some respects, helping the research that we're doing, but these things are available and should be lots of fun for you to work with. So next week we don't have a webinar. We're going to be up at the MTA Symposium in New York. So if you're in the area, please do come and see us there at the symposium, and we'll be back in 2 weeks' time with another webinar. Thank you.